If a handful of countries, doesn't matter whether in Europe or the Far East, but they come and they say, hey, we want you to do business here. We're open for business. Come bring your products to France, all over the world. And that is what we're going through right now with tariff heaven. If that does happen to work and Trump ends up being correct and we have 20 treaties in the next 90 days here, does that represent a manufacturing boom to the United States? And then it becomes, wow, I don't want to miss this. I've got the fear of missing out moment. I better start investing more money.
Honestly, I think that until we have the 90-day tariff pause end, which will happen on July 7th, happens to be very close to July 4th, a great time for a president to make big announcements about what's going on. Until that point, I think that the range of potential scenarios past then is simply too large. So then what do we do in the interim when we're figuring out who would be the more likely winner and loser here? In the US markets, I think it's more helpful to focus on investment principles and investment themes as opposed to sector selection. One example why sectors might be a little bit less helpful to us right now, exactly your point, energy. Energy is a typically more cyclical sector, right? When the economy is decelerating, as it is today, that would typically be something that investors would stay away from. However, exactly to your point, we see a lot of reasons for the US to be leaning into energy independence. We also see huge energy needs stemming from our investment in digital infrastructure, trying to make sure that we lead on the artificial intelligence side of things. Simply classifying energy as a cyclical asset class that does better when the economy does better is less helpful right now. What I think is very helpful is focusing at a time like this on quality. Now, quality is easy to talk about, but what do we actually mean? In equities, I'm talking about strong earnings growth, or at least resilient earnings growth. I'm talking about really strong coverage of any debt obligations. Frankly, a very straightforward way to consider that theme, implementing it, is with dividend yielding equities. These tend to be larger cap or larger companies that have a bit more of a buffer against the cycle. They tend to be value companies, so really nice, strong, stable business models, and they tend to protect that dividend with everything that they have got. What are the companies or the areas where all this policy uncertainty and higher tariffs is not going to affect a company's ability to pay its debt? And in that sense, of course, now can be an interesting time to consider investment grade corporate credit. It can be a great time to consider taxable municipal bonds where we actually see a lot of credit quality. But it can also be an interesting time for high yield corporate credit because we are seeing the difference in spreads between high yield corporate credit and risk-free credit or treasuries. We're seeing that get wider. And frankly, it can be a moment where that creates a lot of value for investors and actually an opportunity to participate in a relatively speaking high quality asset class where we don't expect tariffs to create a systemic credit quality problem.